Picture 4 people sitting at a table, passing the same $100 bill around and around, each one pocketing it for a second, calling it income, then handing it to the next person in line. On paper, everyone just got richer. In the room, nothing actually changed hands. That's a decent picture of how the biggest companies in AI are making their money right now. Nvidia sells chips to OpenAI. OpenAI needs cash to buy them, so Nvidia invests in OpenAI. Microsoft pays OpenAI's bills, OpenAI's usage props up Microsoft's numbers, and Microsoft turns around and buys more chips from Nvidia.
OpenAI financed a massive data center in Ohio.
OpenAI is negotiating with Nvidia to guarantee about $250 billion in data center loans.
GPT Maker was able to make this move after striking a deal with Microsoft, which is its largest investor.
Nvidia's CFO said the chipmaker's deal to invest $100 billion in ChatGPT parent OpenAI.
Nvidia and OpenAI discussed a massive $100 billion investment plan.
The dollar keeps moving. What it isn't doing in a lot of these deals is turning into profit, or anything you or I could point to and call a finished product. Which raises the question nobody in Silicon Valley wants asked out loud. Is this $1 trillion industry, or a very expensive bet that the profits will show up eventually? Here's the number that should stop you mid-scroll. This year alone, OpenAI signed roughly $1 trillion in infrastructure deals. $300 billion to Oracle, up to $100 billion pledged by Nvidia as an equity stake, though Nvidia's own CEO has since called that figure less a firm commitment than an invitation, walking it back even as the number kept making headlines. $250 billion in cloud services from Microsoft, plus tens of billions more scattered across AMD, Amazon, and CoreWeave, a company most Americans have never heard of. One business, never profitable on an annual basis, now obligated to spend more than the GDP of Spain. The part that should really grab your attention is much of that money never really leaves the building. Wall Street has a term for it: circular deals. It's the same $100 bill from a minute ago, just with more zeros and better PR. Nvidia sits at the center of that performance, and its books show it plainly. Data centers now account for close to 90% of the company's total revenue. The company sells processors to the hyperscalers, takes equity stakes in the startups burning through those processors, then reports the resulting demand as proof of a healthy organic market. It's a closed feedback loop masquerading as an open one. The reach of this isn't confined to Silicon Valley zip codes either. Nvidia's chips are flowing to cloud providers who rent them out by the hour, and to foreign governments writing checks of their own. South Korea, Saudi Arabia, the UK.
Microsoft says it will be shipping Nvidia's most advanced AI chips to the United Arab Emirates. Chipmaker, now the world's largest company, it has just announced billions of pounds of investment to help develop data centers.
Nvidia has announced plans to supply South Korea with a lot more of its most advanced chips.
All racing to secure compute capacity before their neighbors do. What started as a domestic infrastructure story has become something closer to a resource competition, with GPUs standing in for the oil reserves of a previous era. Nations that once stockpiled crude are now stockpiling processing power, betting that whoever controls the compute controls the next several decades of economic leverage. None of this is happening in the abstract. It's happening in poured concrete, steel lattice, and transformers the size of school buses. Global data center capacity is on pace to roughly double by the end of the decade, and a striking share of that growth is landing in places that used to define themselves by grain elevators and assembly lines, not fiber optic lines. Former industrial corridors are turning into server farms virtually overnight. County commissioners who once haggled over zoning variances for hog barns are now negotiating decade-long tax abatements with companies whose market capitalizations dwarf entire national economies. Somewhere in one of those counties is a person who spent years working at a plant that closed, watched the developers arrive promising thousands of jobs, and now drives past a facility the size of 6 football fields that employs a security guard and maybe 4 technicians on a good shift. City council meetings that used to run 20 minutes now stretch past midnight, packed with residents asking why their water pressure drops every afternoon, or why the substantiation grade got fast-tracked for the server farm, but not for the elementary school next door. The tax base grew. The town didn't. That's where the story actually lives, in council meetings that run past midnight. The electricity bill for all that concrete is starting to arrive. Data centers currently draw somewhere around 1.5% of the world's electricity, a number that looks almost trivial until you clock the slope of the curve. It's projected to roughly double by 2030. And in the United States specifically, some federal energy modeling puts data centers as high as 12% of total electricity consumption within the next several years. 12%. For buildings that, once finished, need a fraction of the workforce a mid-sized factory would have carried. Utilities are approving new gas plants and delaying coal retirements specifically to keep pace. And residential ratepayers 100 miles from the nearest server are footing part of the bill. Zoom out from the individual and look at what this building is doing to a wider economy, because the picture gets stranger, not clearer. In the first half of 2025, AI-related capital expenditure added somewhere around a full percentage point to US GDP growth. Strip that contribution back out and several quarters of growth would have looked a lot closer to standing still. The country isn't merely investing in artificial intelligence anymore. In a measurable, load-bearing sense, it's currently running on it, propped up by server orders and chips shipments while manufacturing, retail, and housing fall by the wayside. Dependency like that has a way of ending badly, and a market has a long memory of exactly how badly. In March 2000, the dot-com crash erased roughly $5 trillion in market value over 2 years, liquidating companies that had built entire business models on the assumption traffic would eventually convert into revenue. It mostly never did. Not on the timeline anyone needed it to. Today's parallel isn't a perfect echo. These AI giants generate real revenue, not just page views, but the psychology rhymes uncomfortably well. Infrastructure poured years ahead of demonstrated demand, financed on the belief that growth would show up to fill the gap later. The markets are starting to hear that rhyme too. In Bank of America's most recent survey of global fund managers, an AI bubble ranked as their single biggest fear for the first time, ahead of inflation, ahead of geopolitics. And yet, where they're asked point blank whether AI stocks are already in one, most still won't answer yes. That's not comfort. It's a professional class that manages other people's retirement savings, staring hard at the spreadsheet, terrified of the outcome, and still not willing to call it. Oracle gave the market a preview of what that nerve loss looks like in practice. Late last year, the company told investors its spending for the fiscal year would land $15 billion higher than projected just months earlier. A revision so large and so abrupt, it rattled confidence across the entire sector and triggered a wave of price target cuts from analysts who'd been cheerleading the AI build-out for 2 years straight. $15 billion of surprise, delivered on a single earnings call, from a company whose spending is now tethered almost entirely to one still unprofitable customer writing the checks. A few months later, Microsoft and Meta reported earnings on the same day, and the market handed down two verdicts that couldn't have looked more different if they'd tried. Meta jumped double digits after convincing investors its AI spending was converting into real advertising revenue. Microsoft dropped by a similar margin that same morning, punished not for spending too little, but for failing to prove its cloud business was turning that spending into growth fast enough. Same industry, same week, same trillion-dollar infrastructure story, told by two companies sitting a few miles apart in market cap. Opposite verdicts, because the story only holds as long as the numbers keep backing it up in real time. That divergence is the tell. Investors aren't rejecting artificial intelligence as a technology, they're demanding receipts. And receipts, in an industry this capital intensive, takes years to arrive. Years these companies may not have if sentiment turns before the concrete finishes paying for itself. Here's the deeper fracture line, the one that sits like a crack in a foundation beam. This boom is financed by circularity, and circularity has a weak point built into its design. Pull one thread, a missed OpenAI payment, a stalled Oracle build, a chip shortage that delays a Microsoft rollout, and the vibration doesn't stay contained to that one company. It travels through every party in the chain, because in a system this interconnected, nobody's risk really belongs to them alone anymore. Every balance sheet is quietly co-signed by every other balance sheet in the loop. For now, that risk is still theoretical, more a possibility than a headline. The data centers keep risking, the chips keep shipping, the revenue is still real, even if a meaningful chunk of it is chasing its own tail on the way to the income statement. Theoretical risk, though, has a habit of turning very real very fast. The moment one link in the chain can't make good on a promise it signed 2 years earlier, back when the future looked infinitely more certain than it does today. So where does that leave the rest of us? The people who don't sit on Oracle's board or trade Nvidia options for a living, but whose electricity bills are climbing anyway, whose local economies are being quietly rewritten by facilities that generate tax revenue and almost no jobs? It leaves us needing to ask sharper questions than the ones Silicon Valley is currently answering for us. The question isn't whether artificial intelligence is real. It obviously is, and its usefulness isn't in dispute here. The real question is whether the financing behind it is sustainable, or whether a handful of companies are building the most expensive circular argument in corporate history, each one pointing at the other as proof the spending makes sense. Nobody knows yet how this resolves. Maybe productivity gains eventually catch up to the capital expenditure, and this decade gets remembered the way we remember the railroads. Wildly overbuilt in the moment, transformative with 20 years of hindsight. Or maybe the loop breaks somewhere nobody's watching closely enough, and the fallout lands hardest on the towns that surrendered their farmland for data centers that never delivered the workforce they promised on a glossy rendering. Either outcome starts the same way, with paying attention now before the story gets written for you. Watch which companies start needing to explain their numbers instead of simply announcing them. Because in a system built on circular money, the truth eventually surfaces in the one place it can't be spun: the cash that's actually left over once everyone in the loop stops paying for everyone else.